What about income tax and a charitable trust? Have you ever wondered how income tax affects charitable trusts? Understanding this can be a game changer for your estate planning. Let's break it down. A charitable trust is a legal setup where you place assets into a trust for the benefit of a charity or charities. There are two main types of charitable trusts: charitable remainder trusts and charitable lead trusts. In a charitable remainder trust, you or other non-charitable beneficiaries receive income from the trust for a specific period. After that, the remaining assets go to charity. On the other hand, a charitable lead trust gives income to the charity for a set time, with the remaining assets going to non-charitable beneficiaries afterward. Now, let's talk about income tax benefits and considerations when it comes to charitable trusts. First, when you fund a charitable trust, you might qualify for an income tax deduction. This deduction is based on several factors, including the type of trust and the expected value of the charitable interest. It is not for the full value of the assets but rather for the present value of what will eventually go to charity. The Internal Revenue Service has strict rules for calculating this deduction, so it's wise to consult a professional. Next, consider how income from the trust is taxed. For charitable remainder trusts, the income payments to non-charitable beneficiaries are taxable. These payments are reported to beneficiaries on Schedule K1, which is a form used for reporting income. The taxation follows a specific order, first as ordinary income, then as capital gains, and finally as tax-free principal if all other income is exhausted. This means that beneficiaries pay income tax on distributions, but the rate can vary based on the type of income. Another important aspect is capital gains tax. If you transfer appreciated assets, like stocks or real estate, into a charitable trust, you can avoid immediate capital gains tax that would apply if you sold those assets directly. The trust can sell these assets without triggering capital gains tax, allowing more funds to remain for investment and distribution. Additionally, assets placed in a charitable trust are usually removed from your taxable estate. This can help reduce or even eliminate estate taxes for your heirs. It makes charitable trusts a useful tool in estate planning. However, it is essential to note that charitable trusts themselves are not considered tax-exempt organizations by the Internal Revenue Service. The charities that receive the assets must be recognized as tax-exempt to qualify for the tax benefits. Depending on the structure of the trust, it may also be subject to certain excise taxes on investment income. Lastly, once you place assets into a charitable trust, you cannot take them back. This is a significant consideration for estate planning, as it ensures that the assets are dedicated to the intended charitable purpose. In summary, charitable trusts can provide significant income tax deductions, help beneficiaries avoid capital gains tax, and reduce estate taxes. However, the rules are complex, and the benefits depend on how the trust is structured and the types of assets involved. Working with an experienced professional can help you navigate these rules effectively.